I couldn't get the Zoom to run through YouTube, so it's still going to run through the restream, but at least we have the live stream in better quality. All right. Well, they'll show up if they want to show up. It's recorded, so whatever. I put in a a little bit of a video on the 111 and the 1236 because there's people that had been asking about it, and even though I have talked it over in live streams, I couldn't remember where those live streams were at. So I just made a little video. I posted it in the stream replay so people can find it. We got nothing today, really. We're just hanging out at these lows, and unless we get some sort of headline that kicks everything off, I'm not expecting that we do anything more than just spend the rest of the day down here and call it quits. I mean, we might end up with something else, but that's really all I expect is we're just going to hang out and go into the close. There has been a lot of war saber rattling, and it's possible that something kind of escalates off of that, but not quite sure. There was something I wanted to point out to people. Have you seen that article from Centrini Research? This here, the 2028 global intelligence crisis. Notice the date, right? 2028. So it was this sort of hypothetical scenario about how AI could disrupt things, different companies, and completely crash the global economy, removing jobs, and then of course people don't go to work, so they're not spending money, and it just creates this sort of feedback loop, and everything completely crashes. What a mess, right? It came out this week, I think, and Centrini Research is not just some, Joe Schmo writing articles in his mommy's basement. So it got a lot of eyeballs, and some people said it's one of the reasons for the weakness we saw in software and in the market. So it's turned into quite a bit of a deal. A lot of not complaints necessarily, a lot of perspectives on it. If you haven't read it, it's worth a read. Um, at Seeking Alpha, they actually did an article about it, right? Like somebody else wrote an article about it. If you haven't read it, I can share a link for it. Um, it's on Substack, but it was one of those Substacks that are free as long as you've got a Substack account. Then you can read it. It's eye-opening, scary, but eye-opening. It's a big read. Unfortunately, it's not one of those articles that you could just read through really quick. But yeah, it was kind of freaky. Hey, Marziti, what's going on with you? I see your mic is available, but I'm not hearing you. No, yeah, all good. I was just talking about that article from Citrini Research. I was trying to find the quick way back to the Seeking Alpha article, but I couldn't find it. So I'm gonna go back to the chat. Hey, I hear you now. Well, on Wednesday, everybody had finally reached their breaking point where they said they were just really fed up with not being able to clearly see the screen. Using the Discord live stream, I guess, was just really blurry, and people reached the breaking point. So we're using Zoom, and that way it's crystal clear, it's clean, and the restream is still going to YouTube. So, you know, there's that. The good the good thing is that for the Zoom recording anyways, you'll actually be heard on the recording. It's nice because for some reason my Discord recordings wasn't picking up anybody who was chatting in the background. What did you think of that 2028 article? It's a big read. Really it is. I shouldn't have put you on the spot like that. It is a big read. Takes time to chew your way through it. I was talking to AI about that article and it was giving some numbers. It said about 80% of the people that are in the trading space who read that article kind of dismissed it as fantasy and kind of overblown, overreaching. And that 20% of the people who read it was like, oh, damn, that's spot on. I can really see that happening. And I was talking to the wife about that afterwards, and it's like, I've met so many people who are in the trading space who just don't understand what's going on. They might have a very small grasp of the thing that they're doing, but they don't understand the bigger picture. And I would not be surprised that the 20% who agreed with the article are probably mostly filled with people who don't understand what the hell's going on to begin with, and they're just nodding their head and agreeing, but they didn't understand the nuances of what the article was even talking about. That's my stake in it. 'Cause- I've definitely noticed in the last 2 weeks a lot of talking in the book, where they're trying to say that companies like App 11 are fine. APP. Oh, it's fine. There's nothing wrong with App 11. Everything is fine, but it's not fine. Companies that are vertical integration don't have anywhere to go, and AI is going to eat their lunch. So companies like App 11 are toast. They're done. But if you can convince people to go in and buy it, then the at least the corporate banks are going to have that exit liquidity. Because think about it. for those who are unfamiliar with the term, vertical integration is the idea that a company has one thing that they do, right? That they're not diversified into multiple fields. So you take something like AppLovin, who's mainly trying to eliminate friction between the human side of something and the digital side of something. So they're like, hey, we'll make your life easier. Buy our product, and you'll be able to perform blah blah service. But AI can now do that service and do it cheaper and faster. So why do you need AppLovin if you can just get AI to do what you was doing on AppLovin, what you was doing on AppLovin? You can have AI do it for you cheaper and faster. So there goes AppLovin, right? Poof, gone. Unless that company comes out with an entirely new product to offer to society, then there is no reason to ever need a subscription to AppLovin, and that company is just gone. That was so cool, by the way. I had a lot of questions about that Star Trek video when it came out. What a great representation of what the technology can do, right? But when I watched it, I was like, wow, okay, was the song made by AI? Was the voice solely made by AI? Or did they hire a voice actor? Did somebody else write the song? Like they were, that was just really amazing. I haven't seen any of them except the Star Trek one. I really need to, right? Like, it's really scary how amazing that is. Because I've got this issue with falling in love with TV shows that last for 15 years and then they just suddenly yank it off the television and it's gone. Drives me crazy when they do that, right? Like, we're big fans of House MD. I loved that show. And then they just wrapped it up. First, they broke it so badly you didn't even want to watch it anymore, and then they yanked it off the air. Or NCIS, was around for 20 years, and then suddenly they broke it badly enough that it couldn't survive, and they took it off the air. If you could start making shows like that with AI, and nobody is real in the show. They don't age, they don't die off, they don't have kids or get contracts to go get into another TV show. And these series could last forever, right? Like The Simpsons, they don't age if you don't want them to because it's just animation. Who cares? That one tiny idea right there that, um, you know, television series could theoretically now last forever simply because the actors never need to age if you don't want them to. And since you're running the whole thing with AI, you could generate what they looked like in their teens as a old person somewhere in between. Like there's just so many possibilities just from that one idea. Makes you wonder what we'll be trading in 5 years. Yeah, I think there's still going to be a lot of opportunity. So many new traders don't even know that those kind of tools exist. And then a lot of those tools, you have to be sophisticated enough to adjust them. And new traders don't know what to adjust or, what level to adjust them to. So, imagine the day where new traders could just open up a broker, put money in it, and it's already sophisticated enough that sets itself, it sets its parameters, it goes in and trades, it literally does everything for the trader. Then you wouldn't be a trader, right? You would just be the guy that funnels money into the account and then let it grow from there. And, in theory, the money could be as low as the first trade. So you could just put $5 in there and let it do whatever it wants to do. Leave it alone and come back 30 years later but that is so far beyond what's uh what's out there at the moment because so many things move for the wrong reasons. It's not because their debt to ratio is right or because the company is making a great product or you know what I mean? Like things move up and down because some rumor or headline, uh, some competition, a butterfly flapped its wings in Indonesia and the stock went down. If it was rational, then the market would be an entirely different marketplace. Oh yeah, absolutely. Like just a fake headline about the Strait of Hormuz being closed fully would spike oil up to $150 a barrel immediately. I keep a home phone. You know what I mean? Like an act. I yeah, I do. I to this day still have a home phone, and people ask me like, why? Why do you? And it's like because I don't want to give away my cell phone number, right? So we give companies, corporations, we give them the house phone, and we just keep it muted to where every call just goes to the answering machine, and it is a nonstop call all the time of these callers that just hang up, and the caller ID will say, you know, Lincoln, Nebraska, Oklahoma City, Oklahoma, and yet you try to answer it and there's nobody there, and it's just this nonstop ring all day, every day, and we don't even mess with it. You know what I mean? Like, we just we could put people on the moon, but they can't design a an app that protects our text chat and our cell phones from scammers and well, it's just nuts. You have to buy an app, you know, get a subscription that protects you from these callers and these scammers. And we shouldn't have to. In the last month or so, in my live streams, we've built weekly iron condors that actually had enough credit that they were viable opportunities. And that got me really curious about the idea that maybe our weekly irons were back again. But I did some digging and they're not back. It's a bit of a fluke. We've got enough volatility priced into the options right now that when you build the spread, it has enough credit to where we look at it and we say, oh, well, you know, yeah, it's got enough credit. I guess we could run a weekly iron. But it's not because the spreads are narrow enough that we're close enough to the money that we're getting the proper amount of credit. Instead, it's, well, we can still be that far out and the options have so much juice to them that we're getting credit even at that distance. So if you do the count and you expect a win rate of the standard deviation, 70% win rate, and you look at the amount of credit that you get, is it good enough? Count back. We're not getting a 70% standard deviation, and that means we're not getting enough credit. We have to get enough credit to win 50% of the time. And if you get $2 in a $5 spread and then you close the trade early, so now you're only getting $1, but you still risked three, technically four, then no, $1 is not enough credit in a $5 spread when you're only winning 50% of the time. Can't do the trade. But that still got me thinking, well, why not look at some of the other strategies, because there's so much volatility in the market right now, that maybe we could, find some other mechanical play, because there is a lot of juice right now. There's a lot of juice in the market. Why not, right? It doesn't hurt to give it a shot, but it's hard to back test that idea, because then we have to stay restricted into a small period of time, like 1 year. I think 2 years would probably be a bit too much. It really is an awesome site. One of the things I've continued to ask them to provide is the standard deviation, to be able to identify tradable, back tested tradable opportunities on where that standard deviation was projected from one day to the next, 1 week, 1 month. And it's not like we're asking for too much. You can pull up any broker that offers options, and you can see the one standard deviation implied volatility projection on any broker that offers options for 1 day, 1 week, 1 month, 1 year. You can just scroll out 1 year and you can see how far should we move in the next year. So if I can do that on the platform, why can't I trade that, right? And then run that back test and see the outcome. And they still, that's my one complaint with them, is they still have never added that to the site. I've always been taught that there is just so much money that is placed into the options market every day, every week, based on these um, distances. And if that's true, then let's profit from it, right? If it's not true, then let's dispel the myth and see it in the back testing and scratch that out of our vocabulary so we just don't use it anymore. Next week has an expected range of 150 points for the SPX. So, yeah, combined, that's 300 points from top to bottom. It's a huge, huge range, which is why I keep arguing that, the iron condor that we used to run is dead. We just can't run it anymore, even if we are getting the proper amount of credit at the moment. If we go from 68.50 and we go 150 out, then that would be, 67, 66, 6600. That would be one side, right? All the way out. So we'll sell the 6600, and I'm just going to start with a $5 wide spread. And then on the other side from 68.50, we go up 50, that's 69. And so we're looking at 7,000 on the other side. So we'll sell that and buy that. We're looking at, ooh, not even a dollar. We did this last Friday and we got $2 in credit. Right now we're getting $1.35, not even the $2 that we had last week. And so with this, even if we made max profit, if we didn't close early, this is not enough money to run the strategy. Yeah, you can't take a max loss like that. That's $3.70 as a max loss. And that means 1 out of 4 trades that's all it would take, right, to wipe you out. If you lost 1 trade in 4, you'd be back to scratch. Ballparking it there a little bit, but that's the idea, right? That it's just inconceivable. This is not enough credit. We need a win rate that's much higher than the 70% of the one standard deviation. And if we start closing them early, the way that most people do, then it's really screwed. So here I just adjusted the width for March 6th. That's next Friday's expiration, 1 week out. And we can see that I'm actually shifted the wrong way. I missed something somewhere from 68.50. That should have been 6,800. Oh, I need to go with 6,700, not 66. I went too deep to the downside. So 67 and then 67.05. I was a little too deep on the put side. Yep. There we go. So now we got $1.60. That's a little closer to the $2 we were seeing last week. But look at the gray area. The gray area is a one standard deviation based on price action for the expiration that we've got up here, March 6th. And what we've got calculated here is the one standard deviation based on the options implied volatility for next week. So that's why they don't match, right? One's based on basically implied vols from the chart, and one's based on implied vols from the options, and they don't match. Price says we can go farther than the options are saying we can go. If we built it even farther out to match that level, there wouldn't be any money left in it. In this 300-point range, the chance that we close inside of this is supposed to be 7 out of 10 trades. So in theory, we should be able to go to the weekly expected move chart, count back 10 weeks, and see that we closed inside the line 7 out of those 10. I have found over the years that short weeks are dangerous. So if it was a holiday week, then I don't like to count that. And then I just don't trade that either. Because if you're not going to count it, you can't trade it, right? You got to be fair. And that might adjust the formula a little bit. But then I also don't do these if I know it's going to be an FOMC week, or if I know that we've got, say, non-farm payrolls that week, or on OPEX week on a triple witch, like we're going to have in March. March is going to be a triple witch. Then, it kind of gets into that iffy, like, hey, I don't want to trade them in that scenario. I was listening to an analyst talk this week who was talking about the threat to markets from an escalation in war tensions for late March based on the end of Ramadan. And looking at the headlines today, it doesn't look like we're even going to make it to March before we kick off with some war in the Middle East. But say we don't kick off over this weekend and it actually continues to expand, then we've got late March for the end of Ramadan and the opportunity for escalation in the Middle East at that point. So that's something to consider too. Yep. All we did was doubled everything, so it didn't help. But that's the fallacy or the trap, right? That people often fall into is um, I seen someone the other day doing a $1 wide spread, and I think it was a butterfly. That it was $1 wide, and nope, it had to be an iron because they were getting credit. So they did the spread as $1 wide, and they're like, "Well, I only got 18 cents, so I did five of them." Like, okay, but that's 85 cents of risk times five. Like that's the solution isn't to add more to try to make more money because that just increased your risk. It was a it was an iron. Yeah. Yeah, that was my other argument too. So for those that are listening in, if you don't trade a daily 0 day play, here's some factors to keep in mind. That in the 0 day argument, sell side is the preferred approach. So if you're 0 day trading in options, stop thinking that buying is the norm, because it's only the norm for retail traders who are trying to scalp. For everybody who's doing the quote real 0 day plays, they're selling to open something. If your account can handle it, then naked puts and calls. Otherwise, some form of a vertical, either a short put or a short call vertical, which can easily be converted into iron condors, right? And that's what we're chatting about. Now, SPX, you can't go $1 wide. So we know he wasn't doing SPX. He was on he was on SPY. So then we're talking about selling to open. So if the daily rational is, oh, I can go in and I can sell options every single day in the S&P or the Qs, because we don't need to be, stuck on just the S&P. What would we want to trade? Short call verticals and short put verticals, right? That's the logic. That all good. I'm glad that you contributed. Let me highlight what the normal play is, and then point out what you really have to watch for and what I've come up with for solutions to what we have to watch for. So, generally speaking, people are opening the trades today for a 0 day. I know that sounds kind of obvious, but it doesn't have to be that obvious because I could open near the end of the day yesterday. I could have opened today's trade. That's a way to do 0 days without getting the PDT, right? You put it on the night before the market closes and you have today's 0 day without the PDT. The problem is you have to be able to anticipate what tomorrow's price is going to be today, right? So there is that problem. But the bonus is you do get the overnight premium. So you get a little bit more juice, a little more bang for your buck, but you still have the problem of, what's the market going to do? Is it going to gap up overnight? Whatever. So that's one issue or one way to get around the 0 days. Then there's all day trade. If you look at the numbers and you talk to enough traders, the ones that are really struggling are trying to hold a 0 day all day. What I've come up with to eliminate this issue is that if I want one in the morning, I'm going to close it around lunch. No matter how it's doing, I'm going to get out of the darn thing before we get into that lunch window. Or I'll open it in the afternoon and I'll just deal with the afternoon one. If you try to hold it all day, the S&P and the indexes in general, they are mean reverting products. I know that sounds like fancy language, but it just means that we go back where we came from. And it doesn't have to go all the way back where we came from, but it heads back in the general direction of where we started. So if we went up in the first part of the day, expect to go down in the second half of the day, or vice versa. If we went down in the morning, expect to go up in the afternoon. That's mean reversion. And mean reversion happens way more than continuation, way more. So we then have to focus on, was today a day where we moved anywhere at all? And if we did move somewhere, are we going to mean revert? Just because we mean revert a lot doesn't mean we mean revert every day, because we don't go every day. Some days we just sit sideways. And if it's going to be a sideways day, do we still want to put on a 0 day trade? At first blush, why not? If we're sideways, we've got a tight range. We can just play an iron condor on that tight range or play the edge of the range with a short vertical on the call side or on the put side, and we can call it good. The problem with a market that hasn't gone anywhere at all, say like today, we opened up low. So we're down on the day, almost 1% by the lows, but we're down on the day and we haven't really gone anywhere since we opened. We have a 50-point range and we're sitting inside of it and we're just not doing anything. This is a day that looks appealing for a 0 day trade. Why not? We haven't done anything. The reason you might want to avoid a day like this where we haven't done anything is because the market is primed like a coiled spring. And if you've ever messed with a coiled spring, you know that just one flick out of balance and that thing is going to shoot across the room. The same thing with the market. If it's coiled up, ready to go with all that energy, one headline, one spark, and that thing is going to shoot up or down, and it can very likely blow your position right out of the water. So, a day where we haven't moved is more dangerous than a day where we already did move. That's one of the tricks, or one of the uh, fool's errands that we've all fallen into at some point. Oh, it's sideways. Let's go put an iron condor on it. Be very careful of that logic. It doesn't mean you can't do it or you shouldn't, just that it's not as safe as it appears, right? You're actually at a greater risk when you do that because it hasn't gone anywhere and it's got all that stored up energy just ready to make a move. So instead of or worse. The gurus out there will suggest that for newer traders who can't really read the market that well, that you should just get farther away. If you get far enough away, so say the gurus, then you'll have a high probability, high win rate trade strategy. And that appeals to new traders because they want to win all the time. The problem with that is it doesn't matter if you win 99 times out of 100. The problem is how much money did you get when you did win, and how much money are you going to lose when you do get a loser? So they'll fool you and say you should just go far out of the money because you're going to win a lot. Don't do that. And here's my solution to that. If you go far out of the money, you won't get very much money, right? The argument to that is, so what if you only get a little bit? You could just put a lot of them on, put 20 of them on. Who cares? You'll get enough money if you just size up enough. The problem is if you go far out of the money, you don't know when to close the loser if you're wrong. So here's today's range. 68.80 is the high of the day. And if I go out to just that, if I just use the high of the day and I build a call credit spread out there, I can get $2 and some change, 280. Hey, that's not bad. I'm risking 220 for a chance to make 280. What's my risk? Well, price could come up and hit the high of day. Okay, I mean that's a pretty good sized risk, but at least I can see what's going on. This trade will start to lose as soon as price crosses this cyan line. It'll start to go red. It'll happen sooner than that, but I want to give you a visual. So as soon as price crosses that cyan line, this trade is losing. When it gets to the yellow line, the trade is now down $200. That's all it's going to take. We just go from here to there, and I'm now losing $200. Once it gets to the green line, this trade is 100% lost. Now remember, at the end of the day, as long as it closes lower than this, I will be profitable. But that's at the end of the day. And if it already got this high, what's to say that it won't just continue to go on up and tack me out, right? So if you think, well, I'll just close it when it starts to lose, you would be closing it way down here. and you still wouldn't know, should I close this? Well, it's losing, but I'm not a loser until the end of the day, and only if it gets higher than this. I should probably just stay in. By the time you know that the trade is completely trash, say like price getting up here, you're already 100% lost. So there's no good way. And I'm close. This is considered close to price. What I see people doing, because that's what the gurus tell them, is go way out of the money. Go to a 10 delta. Go that far out. Well, let's just put on a 10 delta and see where that 10 delta is. I'm betting it's somewhere above 7,000, but it is late in the day, so maybe it's a little closer than that. But let's just see, where's that 10 delta? I need more strikes. So it's not at 6,900. 10 delta would be, well, it's not at 7,000 either. Where's that 10 delta? There's a 10 delta, 70.15. If I built this trade with a 10 delta, I could get 55 cents. Yay, I'm risking $445 for a chance to make $55. And as long as I actually close it at expiration, uh, getting the most money I could get, I can get it all. But most people don't do that because the gurus say just take 50% profit. So, we sell it for 60 cents, we make 30 cents on it. Yay. And they'll say, "Oh, you're safe because you went all the way out there. You're going to win 90% of the time. 10 delta, you will win 9 out of 10 trades." We're not getting enough money here to win 9 out of 10 trades. So here's what they tell you. Go to a 10 delta, go way out of the money, put on your trade, and your break even in my example here would be way up here. As long as price closes underneath that, you're not in a losing trade. And so if price even starts moving to you, your trade is going to start to lose. And there is no good way to figure out when should I close this trade if it's losing. My solution to this problem is don't put these on. I know they feel good, they feel comfortable. Like I would feel safe if price is at 68.50 and I'm putting on a trade at 70.15. It's 165 points away. That's going to feel pretty safe. Like, oh, yeah, there's no way price is going to get me way up here because it's going to have to break yesterday's low, come back inside of yesterday's range, run all the way through that, break out the top, run even higher, and then finally hit me. Surely that's a safe trade, right? Sure, 9 out of 10 times I'm going to win that trade. The problem is there will be a loser. Okay. It's not a maybe, it is a fact. There will be a loser, and it will be a max loss loser. You're going to lose $445, and that's going to wipe out all of those gains. Okay. So if it's a day like one of these days, I'm going to highlight this day right here. This was a continuation day. We fell all the way to lunch, and then we fell even more into the close. That's kind of rare. We don't do that as often as you would think. More often than not, we fall for half the day and then we turn around and we run back up, or we fall for half a day and then we just linger there for the rest of the day. It's very rare to make a move, stall, and then continue to make the move even further. So, what you want to do, what I've done to solve all of this problem is A, I want the market to make a move. Remember, I don't want a sideways day because it's coiled up with a bunch of energy. I want a day where we've already made a significant move on the day, and then I want to see some form of a reversal. It doesn't have to give me good reversal, but I want something. A nice 2 bar reversal would be good, but even just a consolidation at the lows, something, or the highs, right? At the edge, something that says, I think we're done. That way, once we've started to develop that, we get into the afternoon session and I can put my vertical spread along the edge. Maybe I'm 1 strike out of the money or I'm 2 strikes out of the money. That's fine. I'll take it if I have to do that. But I don't want a 10 delta. I don't even want a 20 delta. I want something in the 40s or even in the 50s. I've been aggressive enough that I can start these in the money. There's nothing wrong with that if you think you're going to actually get a move behind it. So if the market's already made a run in one direction and it started to consolidate along those edges, or it's already reversed and started moving the other way, that's the days that I like to do a 0 day play. Your probabilities of success go up a lot. These are not 90% win rate trades, however, right? Because winning all the time, A, is unrealistic and should not be an attainable goal. Don't even try. Don't try to hit some mythical never lose win rate, right? That's just a waste of effort. Instead, focus on the high probability trades, the outcomes, and the days that give you more edge. Sideways days, we have no edge. Leave those alone. Days where we've already made a big move and we've started to show that the big move is done, now you've got edge. Lean against that edge and put your trade on. If you're wrong, say it's one of those days where we do continue to move in the same direction and we did not reverse, you'll know you're wrong easily because you built it near or at the money and it ran you over, and you take a small loss and you move on. That's the key, right? Those gurus that want you to go way out of the money is trying to convince you that no lose or rarely losing is the way to go. And I'm saying, don't waste your time. It's a fool's gold errand that's not attainable. Don't even bother. In a situation like this, we started to build a bit of a base around lunch. It's a little late for lunch, but after lunch, in the afternoon, we're building a base, and maybe we go long here. We put on our put credit spread. It looks good, and then it just breaks the hell down. We got a little bit of a Busby in there, and then it continued to go lower. If you had put on the trade in that scenario, you would lose. No doubt, but you would have a small loss, and you would not have any doubt that the trade is wrong. Like, oh, shoot, I should not have gone long there. That didn't work. And you close it down, you get your hand slapped. But if I had put the trade on using some very far out of the money option, like way down here, once it broke that range and started falling, nothing but doubts. Man, should I close it? I don't know. It's not there yet. Maybe it'll turn around. You just won't have an answer, and it's going to eat you alive. And no matter what you choose, you're not going to be satisfied. And the max losses are crippling, painful losses. You can avoid the whole thing by trading it near the money. Here's the problem with this scenario. If you can see my screen, I built that trade at 70.15. So break even is all the way up here at 70.15. The trade isn't wrong unless price gets to and closes above 70.15 at expiration. So at the end of the day at 4 o'clock. The problem is your trade will go to max loss down here at 6,900. So where do you close the trade? Remember, if you close it at 315 way down here and price rejects anywhere in this and turns around and goes back down, you close your trade as a loser for nothing. And you already hit max loss at 6,900. So at what point did you want to get out of this trade? Because if you close anywhere below 70.15, you closed your trade when it technically wasn't a loser. So far, my argument has been to not use out of the money options, those way out of the money 10 delta options. That's been the argument. In the chat, someone asked about using 2, 3, 4 day options. You can, but one, then it's not a 0 day, right? It's just a trade. And two, the same argument that I'm showing here will still apply to those trades. Unless or until price breaks through your break even line, you're not technically in the loser, but your P&L is going to show that you're hundreds of dollars in loss should you close the trade. There is no answer to this, right? The smartest minds that have analyzed price action, tasty trades, and you name it, anybody out there, no one has solved this problem. When should I close a loser that technically isn't a loser because price has not yet crossed above my break even line? Nobody out there ever has solved this problem. My solution is to just never create this problem to begin with. That is the solution, right? If I never put myself in this scenario, then I never have to try to figure out where should I close this loser. And instead, we change the narrative, change the entire system around so that you are never forced to close a loser that technically isn't a loser. Instead, we start with that blank slate and we can start instead trying to trade a 0 day spread as if we was trading anything else, stock, futures, like where's support, where's resistance. Well, there's the high of the day. Getting a short anywhere or on that high, leaning against it is what I like to say. Getting a trade anywhere near that high for a short in a 0 day would be a smart play. Why? Because we got structure, right? We can see what we need to lose. And if it starts to lose, we just get out and we take a small hand slap and we honestly have solid intelligence about what we should do. That's trading 101 that everybody has agreed with since trading's been around, that leaning against a low risk entry, right? Short off of resistance, long off of support. That's been around forever. And that works. So just eliminate the far out of the money trash. Don't play it. And then we've solved one problem, right? So that's one problem that we've solved. Don't use 10 delta trash. The next problem that we have to solve is, should we do things like an all day trade? Should we start a trade in the middle of the day, like lunch? Now, my own P&L is my own trade history, but what I've learned from my trades is that the most amount of my losers, when I go back and count all the losses that I've had, most of those losses were trades that I opened between 11 and 12. It could just be some theoretical fluke, shoot, it could just be me, but my P&L it doesn't lie, right? Like, the bulk of my losses happened when I opened a trade between 11 and 12. You know what the simplest solution to that was? I don't open trades between 11 and 12 anymore, not 0 day plays. I eliminated the problem because I couldn't figure out any other way to solve this issue. And who cares if I open the trade at 12:30 as opposed to 11:30, right? So maybe I get a little less credit. So what? I eliminated a potential losing streak or losing problem because I just don't open credit spreads between 11 and 12. Now, how about putting it on all day? Put it on in the morning and just run the thing all darn day. Looking at my losses, the next group that lost almost as much as the lunchtime group was the trades that I tried to open and run all day. Those were the second highest losses. So you know what I eliminated was running trades all day long. Instead, I run a morning trade if I do want a morning trade, and then I run an afternoon trade if I do want an afternoon trade. And by doing this, my losses went down significantly. Significantly. I mean, I still lose, right? Because you just can't avoid losing, but I lose way less from very simple things. I didn't need technical analysis. I didn't need to read a book, watch a video, turn into some kind of rocket scientist. All I had to do is look at the clock and not open a trade during lunch or not open a morning trade that I held all day. just doing those two things solved a boatload of my problems. Now, those are my problems. Maybe you would have better luck. But if you look at your own trade history, especially if you're doing this in paper, look at how often you fail and where that failure happened. Maybe you're having the same problem that I have, right? Maybe. That is a good question. At what point in the afternoon do I like to open the trade? Oh, I wish there was a really simple answer to this. The problem is economic data. We have the 1 o'clock auction, and then sometimes we have the 2 o'clock calendar, right? So you have to look at the trading day and first ask, is there anything in the afternoon that I need to be worried about, like the 1 o'clock auction or the 2 o'clock economic calendar? Yes or no? If the answer is yes, then you know what? You probably shouldn't do a 0 day play because you could put one on at 12 o'clock and then get run right the hell over at 1 o'clock. Or you could put one on at 1:15 and then you get screwed at 2 o'clock, right? So if it has those two events in the afternoon, just don't put an afternoon trade on, or at least wait until after 2 o'clock once you've had the 2 o'clock news. All right. That would mean you're getting in after 2 and you've got less than 2 hours to the end of the day. If those don't exist, then it's game on. Game on. We have to figure out, are we done with lunch? Now, most of you haven't been in my coaching service. So, you know, you haven't really probably heard this logic yet. But to me, lunch is not about food. It's not about, the market calling timeout and going to eat somewhere and then coming back. Lunch is about differentiating, are we still in the morning session or are we now in the afternoon session? I call it lunch, but I could have called it chicken soup, uh, broken headlights. It doesn't matter the title, right? Because it has nothing to do with foods and menus and leaving the office space. It just means we stopped doing a morning thing and we're now in an afternoon thing. Sometimes we can see that we're in the afternoon because whatever we were doing in the morning session, we're now doing the complete opposite of. Sometimes we can see lunch because we stopped doing a morning thing, right? So lunch is this theoretical concept that whatever we was doing in the morning session is now done, and that the afternoon, which is a completely different trading session, we might continue to do what we did in the morning, or we might do something completely different. As far as I'm concerned, there is two trading sessions between 9 and 4:30, or 9:30 and 4. I guess that makes more sense. There's two trading sessions. One of them starts at 9:30 and goes until yeah, 11's a good answer, but some theoretical stopping point. And then there's an afternoon session that starts whenever and goes until the end of the day. But when does it start? Sometimes it is 11. Really, most of the time it's 11, except for those economic calendar days where we have an auction at 11. That screws it up. Sometimes it starts a little late, right? Exactly. The candles tell us that the morning is done, right? That we are now in this second part of the day, but we have to see it in the charts to know that we're there. You said it exactly right. You see it in the chart. But sometimes it's hard to spot, like we just do the same thing all day, like fall and fall and fall and fall and fall, and we don't stop, we don't turn around, we just keep falling. On those days, uh, no, Tuesday was the runner day. Wednesday, Thursday. Shoot, what are you talking about? The runner was Tuesday. Yes, sir. We just kept on going. The slow grind. Yep, I took a loss there too. I also took a loss on that because I thought we were done and we were going to fall, and we started the fall, we had a new low, and then it ran right back up and ran me over. But it was a small loss. Like I made it through. It's just a hand slap, no big deal. That was the slow grind day, and those are the days that are the most dangerous to my style of strategy because I'm expecting to mean revert, and we did not mean revert that day. We just kept on grinding higher. So, losses happen. You can't, it's unavoidable. Um, the main thing though is to identify where are your losses coming from. And I've done a lot of research looking at my own trades. I think they're the best educational tool in the world because the pain is real, right? It's your pain. So I take that and I make sure I learn something from my loss so that I get something out of it, a little cash back, so to speak. My losses have highlighted that sideways days are not optimal for those iron condors and that sort of stuff. I don't mind trading a sideways day. I'll put on, a vertical, but not an iron condor. And that if I do want a vertical, then I want the market to have already made a move. And then I want to see that that move is done, that it has stalled in some way or V bottomed or something that says, I think we're done going in that direction. And then I look for us to get into the afternoon. Like I said, though, sometimes you don't see the afternoon even begin. Here's an example of an afternoon that never we just like stayed in lunch for the rest of the day in this scenario here. There was no afternoon, but a lot of times whatever we had in the morning pauses for lunch, and then we come out of that in an afternoon. We come out in the other direction, or we quote start doing something again for an afternoon. And that's what you want to look for, signs that the morning is done. But check that calendar and make sure we don't have a 1 o'clock auction or a 2 o'clock calendar event, because those will screw up your afternoon. The idea is, for me, 0 days should not be a everyday thing. I know we can trade every day, but why the hell do we think we should? And that's been a big argument for me for a long time. Just because I can trade options 0 day every day does not mean that today is a good day to do it, or that the one single strategy, like an iron condor, should be the one that we want to use every day. Maybe way out of the money, cheap, long options is really the better choice, right? Like buying a 7,000 strike call at 9:33 in the morning because we think we're going to get some blowout runner. Sure, why not? I have done that at least twice a week for years. And those lose, 99, 98% of the time. They just lose, right? But it's so small of a loss. It's a nickel. You just shrug and you go on about your day. I literally price the strike that I'm going to choose when I do that by its cost. I will choose, like, all right, well, I'm going to just throw a nickel at that thing. You know what I mean? And I put it on and I lose, and so what? That one didn't work. And I don't care because it's like literally buying a lottery ticket. But when they do hit, man, they pay out really well, really well. It just sucks losing over and 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 over until you finally get one that wins. So swap your strategies around. Try to identify, what tactic do I want to use today? The iron condor, the short vertical, just a straight up long call. Hey, Austin, better late than never, huh? We're still running. It's got 30 minutes left. It's on YouTube now. The quality isn't as good, but it is on YouTube now. So the 0 day play, if you focus on where the troubles are, you can then start to choose solutions to the problem. My solutions work for me. And I am very comfortable with the solutions that I have found. But that doesn't mean that they're everybody's solution. And maybe you'll come up with something that works better for you than what I'm doing. Trust me when I tell you that my way is not the only way. Sometimes my way isn't even the right way. It's just the right way for me. So I focus on what we have highlighted for risk, right? Because that's what you really want to hone in on. Um, I think you were talking about maybe the open range. Maybe it was no, I know. I think maybe it was that one. That right there? Yep, not a problem. This is called an open range indicator. By default, it's using 1 hour, but that's probably not going to meet most people's needs, right? So make sure you open up the indicator and set the time frame to something that you want to use, right? So you load it and then double click it so that you get the user's dialog box right here. And up at the top, you can see the time frames. Just change this one right here to the time frame that you want. 30 minutes is really, really common. 5 minutes is okay, right? Like if you got a plan, if you got some reason to run a 5 minute. Hey Marzita, you have a great weekend, buddy. I I've actually got plans to get the motorcycle out today. It's gonna be the first ride of 2026 because it's 75 degrees out and we've been looking forward to this all week. I'm excited. I did not. Open range. That's a really good one we can cover. So I read a book when I was new to trading that was written back in the day when most traders had a 15-minute delay in their charting software. Can you imagine? Now, to be fair, everybody had the delay. So it wasn't just you, right? Like you, your neighbors, your cousin, everybody was running 15-minute delayed data back in the day. And so the book was arguing that a 1 hour open range was a really good strategy. And when I first read the book, I thought, well, that's I'm gonna have to, put it on the chart and see it for myself. That's really what I had come up with. So of course I did what I've always teach you guys. I went in the past and I drew the 1 hour high and the 1 hour low on days that had already happened. And I looked at what price did during that hour. And sure enough, what they had argued in the book seemed to be very true. That if we stayed inside that 1 hour range, that likely that was the day. And we could just sit in that thing other than wicking out a little bit, that would be your day. Like that first hour, that was it. So I decided, well, I'll just wait until that hour is done and then I'll choose my trades for the day. Unfortunately, that gets you into 10:30 and you're trading right before lunch and then you got the lunch range, you got all those problems. So, the more I looked at it, the more I thought, well, can I use something other than an hour long open range? Like maybe I should try something like a 30-minute open range. The thing is, what I started to notice very quickly is that a 30-minute open range very oftentimes has the same amount as the 1 hour open range. That there really wasn't much of a change between the two. And that got me into the 10 a.m. Earnings releases, or not earnings, but calendar releases. And I would be getting into trades right when we were getting economic data, and that would push the market around and it would cause me to get stopped out due to volatility from 10 a.m. news. So I didn't like the 30-minute range. and I started focusing on a 5 minute range. So with the 5 minute open range, by default, it doesn't have a lot to offer. If we're just looking at every single morning, looking at the 5 minute bar. What I have found though is that some mornings we get an exaggerated 5 minute bar, like a really big monster 5 minute bar. Those I tend to pay more attention to than just your normal everyday 5 minute bar. The 5 minute bar has a lot to offer, right? What I like to do with that really big bar, if it's a big monster bar, is snap my fibs on it. Get my midpoint there. I get my 1, 2, 3, 6, and I let it all play out from there. And it's a really valuable addition to my intraday price action analysis. I love it. But if it's not a big monster 5 minute bar, if it's just one of those regular run of the mill everyday 5 minute bars, it doesn't have anything of value. And instead, I would rather just mark the open on one of those, right? If that's what we're going to get, I would just rather do that. So they're not all created equal, I guess is a good way to lay it out there. And I use the indicator really to just help me spot where that open is or where that first bar is. And to this day, I still focus on where the 50% of that 5 minute bar is. No matter how small it is, no matter how large it is, I track where that 5 minute bar is, where we opened for the day, and where the midpoint of that bar is. As long as we're above the 5 minute open range breakout, then I want to seek out long opportunities. But if we're long on the day and everything starts to fail and we begin to fall, getting back to the 5 minute open range is a price target. It is a destination that I'll aim for, along with VWAP, right? VWAP is always a good thing to aim for as well. Thinkorswim won't show VWAP on SPX, but TradingView will. So we'll just jump over to TradingView and put the SPX on there. That way we can see the VWAP on the SPX. We'll just use this one right there. Why not? I didn't want an auto anchored, but whatever. We'll use it. All right, so way down here, we can see VWAP for the day. The SPX had a VWAP play earlier today when we rolled over on that last fall. It was a great target. I mean, I had targeted VWAP earlier that day, but we didn't get back to it today, right? Until that drop. This one was a fake out. That one was a fake out. But on that drop, yeah, we made it back to VWAP. And then here this afternoon, that's the target that we're aiming for right now, is getting back to that VWAP. But whether you use VWAP or the 5 minute open range, it makes a great destination when we turn around at the lows and start running up, or we turn around at the highs and we start falling down. I like to keep track of that open range. There is a lot of books and statistics and math that goes into open range strategies or just open strategies. There's the true close that has the same kind of logic as an open range. And it's all focused on the price action that we get in the very first part of the trading day. Well, the thing is, most of the stuff that I've seen that focuses on these is generic stuff. Kind of like paint by numbers, only in our case it would be trade by numbers. So it'll say things like if A then B. So here's some very simple stuff that I see in those books. Here's your 30-minute high and there's your 30-minute low. If we break out of that, go long. There you go. Now that sounds great, right? You know what happens? Someone's going to trade it and it'll work 4, 5, 6 times, and then it's not going to work. It's going to break out and then it's going to turn around, run down, and just skewer them. And they'll say, well, what the hell? It didn't work. I need to figure out when it's not going to work. And the problem is that it's not about the indicator, right? It's not about the range. It's not about the indicator. It's about what it always is about, trying to understand what price action is doing and what it's likely to do next. And the indicator is just our visual cue. So draw out the 30-minute box, draw out the 5-minute box, the 1-hour box, whatever box you want. And if it breaks out to the upside, buy it. If it breaks out to the downside, sell it. That's the way the strategy works. And it's going to work X% of the time. 30%, 50%, 90%. How quickly are you taking profit? Are you trying to hold the trade all day? Are you, all of those things are going to affect your win rate. But that's the strategy. It broke to the upside, buy it. It broke to the downside, sell it. Remember, though, it's not about how often does it win. It's about how much do I lose when I'm wrong versus how much do I make when I'm right. Can I minimize the losses and maximize the profits? Better, can I identify the days that I shouldn't even run this strategy at all and maybe just avoid the whole damn thing altogether? You can see I was in here earlier marking out that open range because today we were hovering in that zone enough that I wanted it on my radar. And so I marked it out. I put lipstick on a pig, is what I like to say. I made it pretty. I didn't mean to move it right there, but I did. TradingView does have nice drawing tools. Can't argue against that at all. Being able to add in little emojis and stuff, thumbs up and smiley faces and rocket ships and all kinds of silliness. So it's a pretty simple system. 5-minute, 15-minute, 30-minute, whatever open range you would like, and then trade the breakout. Now we can add to all of this, should I even trade an open range strategy today? And that can be fit into what do we think the trading day is going to offer? Is today supposed to be a day where we run? Have we already run in the pre-market? And are we going to retrace or not? Earlier, we talked about the fact that the indexes are mean reverting markets. The idea of that, while it sounds complicated, like, oh, mean reverting, what the hell does that mean? It mainly means that we go back where we came from. Not all the way, right? Otherwise, we would just have a sideways market forever. But generally speaking, we go down, an eighth of a percent or 8/10, and then we go back up 3/10. We're still down on the day. We're just not as down as we was, right? So mean reverting means the market retraces at least some of the move. And that means we should not try to trade continuation trades as day traders as often as we should try to trade reversals. There are rare days where we just go and go and go and go and go, and we don't look back. Here's one of those examples. We reversed way down here, and we just kept going all the way until the end of the day. We did not retrace that day. I mean, there was little pullbacks to be sure, but a retracement would mean that we closed after going up like that. We came down and we closed, somewhere off those highs. We didn't do that. So those days are very rare, but those days are what so many new traders think every day is. Oh, we broke out, we're going up. I should go long. Most of our days mean revert. So if you try that, you're going to end up with a loss unless you take profit and get ready for the reversal. So, it goes up and you make 25% profit and you close the trade, or 30% profit, right? You got some sort of profit target. In fact, if you're day trading options, we were running a strategy a couple of years back before we had futures. We were day trading options constantly because, we didn't have the futures back then. Well, we didn't have the micro futures. There's always been the minis. But what we would do is we would trade long calls, long puts on breakouts, breakdowns. So we would get long and we would close at 15% profit, 25% profit, 35% profit. Get the idea. And new people would come in and they'd argue, why did you get out? We're not even back at the high of the day yet. We've got all this room to run. You just took profit at 35% and got out of the trade. Yeah, but we were running in the high 80s to low 90s in the win rate. Some of the guys were running at like 95% win rate. They were winning constantly, and when the losses did happen, because it's unavoidable, the losses were small. We were closing the losses at 35 to 45. We weren't even hitting 50% losses. Now, options back then, near the money and at the money in SPY, was around $1.50 to $2. Bad days, they were like $3.50 or $4. And that's when we were like really violent back in the day. So you could spend, $1.50 and buy a call in SPY, and then you could risk, say, 75 cents or, 55, 60 cents. Things were just cheaper back then. The options were a lot cheaper. The volatility is so high now that the options prices are just so much more expensive. So here's Monday's option at the money, $3. You buy that, look for a long that gets you a $1 move in SPY. That's going to be about 50 cents. Well, I mean, that kind of sucks, doesn't it? You spend $3 for the option, you want to make more than 50 cents. Too bad. If you bought that and closed it at 50 cents, you would have a much higher win rate. You'd also have an opportunity to trade again and again and again and again. How do I know it's 50 cents? Look at the difference between these two numbers. If I buy it here and I get out here, or I buy it here and I get out there, that's called strike price shift differential. What do I need for that to happen? For SPY to go up $1. If SPY goes from 685.30 to 686.30, this option will gain 50 cents. I'm ballparking it, but 60 cents now, right there, 60 cents. That's how much I'll make in this trade. If I don't get greedy, just get in, I get my 60 cents, I get right back out again. I will maintain a high win rate and I will grow the account 60 cents at a time. When I'm wrong, I bought it for 340. How much am I willing to lose? Well, I already know I can only make 60 cents. So I don't want to risk more than 60 cents or maybe a dollar, right? Heck, double it. If I'm going to risk 60, I'll lose $1.20. Why not? See how that works. As long as you know what your win rate is, you can run that. Run it at 1-1. If you are looking for 60 cents profit, close your trade at 60 cents loss. That's a risk one to make one scenario. You only need to win 50% of the time and you'll break even. No profit, no loss. If you can win more than 50% of the time with a risk one, make one, you'll grow the account. Just like that. And yeah, it always is price action. It always is. Every answer to every problem always comes back to I need to understand what the market is likely to do next. And the only way to understand what the market is likely to do next is to understand what it's done in the past. And it sucks because there's no shortcut, there's no picture or strategy or indicator or tool that will help us better understand what's price going to do next, other than being able to understand what's happened in the past and have a probability of what's more likely to happen next. But it works. And that's why it's worth the effort because it works. But we don't need it. I can buy a call on Tuesday at 1 o'clock. Just every Tuesday, buy a call at 1 o'clock, and I can make money at the end of the year. It's not based on technical analysis. It's not even based on historical precedent. I just know that it works. So, money management, consistency, those can replace technical analysis. Probabilities and options, those can replace technical analysis too. If you use strike price shift differential and you can trade, say, one strike in the money instead of getting the one that's at the money, go in one, then you might get a better strike price shift differential. This one's 30. It was 30 cents there a moment ago, 40 cents. But if you go way out here, look at the difference. There's no money there, right? Like this is 30 cents, 37 cents. This is 40 cents basically. So the deeper in the money you go, the more you're going to get for a $1 move in price. It sounds really simplistic, but it works. Strike price shift differential, but that's on the buy side. And what we've been talking about for most of the stream is being on the sell side. So maybe in the morning, buying options is your better approach. And then in the afternoon, selling options. You got the 5-minute open range breakout. Buy calls if we break out to the upside. Get one strike price differential. And in the afternoon, sell options. The reason we spent so much time in the first part of the day talking about the out of the money options is because I really want to hammer home how bad that strategy is. And I'm fighting a river because on YouTube, those videos are everywhere. Every wannabe options guru out there is going to tell you that the out of the money 10, 15 delta short vertical trades are your golden sweet spot and that's what you should do. They all tell you that. And so, there I am pounding the drum, arguing that they're all wrong and I'm right. It kind of sounds like I need my head examined, like If you look around and everybody's wrong and you're right, you're a bit conceited. Right? So maybe I'm just conceited, but it's my money and I won't do those far out of the money trades anymore. Hey, did you see that 111 video that I posted today, this morning? I mean, you've been in here asking questions, so I'm pretty sure that that video had nothing new for you because you've been on point, really picking it up with amazing speed. But for anybody who hasn't really been around watching it, check it out because I get asked about those all the time. So those out of the money credit spread trades are just, they're not good. Yeah, it is just a 111 video. I know it's packaged as a replay, and I mainly did that because I wanted to get it on YouTube. And so I kind of danced around Lucian a little bit, right? I kind of cheated. So if I was uploading a video onto YouTube, onto our YouTube, then I would have to make a thumbnail that goes to that. We'd have to fit it into one of the categories that it belongs to, like swing trade or options or this or that. And I was in a hurry and I didn't have time for that. And I didn't want to bother Lucian to make me a thumbnail and all the steps that go into putting a video on our YouTube. But what I could do is I could make a streaming replay video, right? So I turned on my Zoom and I recorded the video about the 111 and I packaged it up as if it was a recap on the 111 or a live stream. So I kind of cheated, but it worked. I mean, I got you guys the video and I didn't have to bother Lucian and, have a new thumbnail made and blah, blah, blah. Right. So to me, it was just a real quick way to get it out there. You do know it really good now. Every day I think about that and I think I can't wait to see what you come up with because everybody that I've taught how to use it has modified it and made it theirs. And I've seen some of your 618 stuff. I like that. That's in line with what I've seen from other people that I've taught how to use it. So so far you're still showing me what I've seen out of others, but I'm holding out because I know you're going to come up with something. Everybody has. Everybody that I've shown it to has adjusted it and made it theirs. And that's kind of the key. If you make it yours, then it becomes something completely different. And that's awesome. It's your first step to a career because I've never seen a successful trader that can only mimic. To this day, I don't know one successful trader who only mimics. Every single successful trader that I know has made their own stuff. Even if it's just a small tweak off of somebody else's stuff, that's still theirs. They learned it enough to tweak the system and made it personal. And that's the key. Without that understanding, we're just mimics. And I say we because I have to learn just like everybody else, right? I see something and I have to recreate it and then start to adjust it and figure out how I'm going to make it mine. But it always starts with recreation. Keep track of your trades, guys. We can call it journaling, call it whatever you want to call it. But if you keep track of your trades, it gives you something to focus on. And I don't mean a log that says I got in here and I got out there, because that is just a log. And a log doesn't give you anything to study. But if you take pictures of your trades, you can go back days, weeks, months, years later with a new thing that you learn, what I call new eyes, right? Like I learned something new, I have fresh eyes. I can take my fresh eyes and look back at a trade from 3 years ago and be like, oh man, look, if I knew now, then I'd have never taken that trade. or I'd have doubled down and taken twice as much in that trade, right? I'd have stayed in longer, got out sooner. So when you take a trade and the trade is done, at the bare minimum, take a picture. You can store them in seconds, right? Hotkeys, you take a picture, throw it in the box. Even if you don't look at it again for 6 months, who cares? You have it, you'll get back to it later because there's only so many ways to get into the trade. When you get that down pat, you'll realize the choices are just there's only so many ways in, right? We set a high here, we tested that high equally and didn't get anywhere. We got a new high and then what we call like a railroad bar or tweezer top, we rolled over. Now you need that bar to close before you have a tweezer top. So we can't trade it as a short because it was a tweezer top, but we can get short when it broke that mid. I use that quite a bit just because of a mid bar. Is every one of my trades a mid bar? Hell no, but I do use that, right? So that's one. Another one that we could use is that the candle closed, right? So the red bar closes, and that's what we needed, and we get short. After that bar closes, the new one opens, we get in. Or it breaks that low and we get in. Like that's the rundown. Those are the three ways you can get in, and then you just keep rotating out which one do you want to use this time, right? There's no wrong answer there. It's just which one of those three do I want to use? Because those are the only three choices I have. There is nothing else. Same scenario. We tested the high, pulled back off of it. The new candle opened. We broke 50% on the way down. That's all I need. I can get in right there. If that isn't it, or it happened too fast and I didn't get in, we broke the low. Now I can get in. If I didn't get that one, I can measure the entire thing from this point to that point and mark the half, and I can get in when it breaks that. That's it. There's only three choices. I'm out of them. You see what I mean? Like there's only so many ways to get into a trade. Now the argument would be, well, I only want to get in on the ones that's going to win. Yeah, me too, but I don't get. You don't know in advance. There is no way to know in advance. You have to just take the trade anyways. Argument is going to say, don't wait for confirmation. Try to get in as close as you can to the top because that's where you're going to want to put your stop anyways. And the trade isn't a loser unless price gets above that. So you might as well put your stop up there. With that knowledge, how far do I need to go? At least twice that distance. This distance and that distance is the same, so I need to go at least one more of those. I need to get back to the low of the range. If I can get in on a break of that mid and make it to the bottom of that range, then that is good. I'll take it. Is it perfect math? No, not always. It actually is this time, but it isn't usually that good. That's how much I have at risk, and that's how much I could make. This seems at least 2x of that. Good enough. So if I take that trade 100 times and look at my own success rate, now I have a pretty good idea of what's my win rate. Am I making enough money to take this trade and continue trading it? I won't know for sure unless I go in and do it because the strike that I choose, the expiration that I choose, how many contracts am I using, and when am I getting out? If I take that with 10 contracts and I start feathering, I'm in with 10 and I get out of 3 when we break that low, and I get out of another 3 when we get through the midpoint of this bar. Now I've only got 4 left, and I get out of 2 more at the bottom of that bar. I'm only into 2 when we get down here to the low. If I ran that ratio different, I would have probably made more money, like holding on to all 10 until we got to the midpoint. But that's just feathering, right? It's adjusting things on the move and just getting more comfortable with the way price is behaving and our ability to read it. So focus on how am I going to get into the trade? There's only 3 ways, maybe 4, right? Study those 4, really examine which one you want to use, You could use the same one every time, but I found that that's not realistic. It doesn't work for me. I want to ask each time, okay, what do I want to use this time? And don't let the trade surprise you. If that high is my goal and we're down here, I know I can't trade until we get back up here. It's not a surprise. I can watch price gyrate around and do what it wants to do. I can go get a drink, walk the dog, grab a snack. By the time it finally gets up there, I'm ready to go. I've been planning for price to get up there for the last 20 minutes. Don't let the trade surprise you. The low of the day, the high of the day, it has to reach that spot first before you even have a chance to do anything else. Did anybody catch this reversal that day? I did. This is what we call one-time framing, when you just get that single bar color over and over and over and over and over and over, and you're waiting for the reversal. I was waiting on that reversal all freaking morning, and then we finally got it. And it wasn't even a good reversal, right? Like a good 2-bar or a really nice pen bar. That would have been fantastic. We didn't get any of that, right? And I was disappointed because on the reversal, it didn't even offer very much, and then it just did that. But whatever. Still, I was waiting for that reversal because I knew it had to come sooner or later. And when that bar closed right there, I knew we were good. That bar. Because look, that's the first bar we had that looked like that. That's all I had. That's all the information I had. And it didn't work out all that well, right? $1.50. It's about all it got. Still, the trade made money, and it wasn't a surprise. It didn't sneak up on me. I was waiting for it. I was waiting for over an hour because I thought we were going to reverse here, and then I thought it was going to be here. Had to keep waiting for the bar to finally change color. But once we had that low, this one was an even better play because we had that one at that point. So, I could have saved an hour and a half of me just waiting and never have traded that low to begin with. And I probably should have. That's what I would have done most days, but I didn't because I was frustrated. I'll just be honest. It pissed me off and I got salty here that it didn't give me what I wanted. And then I was stubbornly waiting after that for it to finally give it to me. Normally, I wouldn't have done that. Yeah, OCC literally means that candle's close. So I don't need another bar. I just need that bar, right? So here we're falling and we're falling and we're falling and we're falling. When this candle closes, I now have my OCC because that candle did close the opposite candle. Now I've got it. And now I could snap my drawing because I finally did get it, right? That would be our OCC right there. Yeah. Yeah, I have mic privileges for everybody, so you should be able to chat. This candle closed and I pulled the trigger here. Yeah, yeah, I never got a trade there. I was waiting for it and I never got it. No, I was just waiting for it to give me a signal long. I don't care what color it was. I just never got a signal long from there. It did. It did, but it never gave me a signal long. There is candle signals, candle patterns. Maybe it's a Pinocchio bar, maybe it's a 2-bar, maybe it's a Marbozu candle. If we rewind to this candle here and it turned blue and it turned around, that alone, I was watching, I was excited, like, hey, it's past 10, I got a green bar, let's do the thing. In the next candle, when it opened, it did not, that wick is there now, but it didn't just like open and run up there. It opened and it screwed around down here, and then it went up there some, and then it went back down here. There was no tradable signal here. And in that whole thing, just because that one is green, it was still underneath the mid of this one. Whereas the one that I pointed out down here, that thing was green and it was at the high of the other one, right? It was already done with all that trash. The reversal was over. Look, it's completely outside of it when it closed. I jumped on the next bar as soon as it opened. This was still underneath the mid, and then the next bar opened and it couldn't even get outside of that bar. There was no long signal there at all. It just left me frustrated and waiting, which is why I got salty and I waited on the sucker all the way down here because it teased me. And then I waited frustrated when I shouldn't, and I normally wouldn't, but I did because it pissed me off. It was like, oh, you dirty dog, you teased me. And then it teased here, and nope, 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 all the way down there. So it's the same logic, right? Mids, highs, lows, there's only so many ways in. So once you have your rules, you know your rules, right? And if you don't have them, you're kind of just floating around without any rules. You're just floating around wondering all the time, like, should I get in? Should I not get in? Should I wait on something? I don't know. Shake the magic 8 ball. What do I do with this thing? But once you've got rules, you already know. And unfortunately, they have to be yours. So in this one, I'm missing a big pin bar. I was really hoping to see a good, beautiful pin bar, but we didn't get one. But this setup right there, I mean, you can just take a picture. Learn this setup right there. It closed higher than the last red bar. Is that enough? Yeah, I mean, it's you can see it wasn't great. We didn't go back to the high a day or anything like that. It was enough to get some profit, and it was enough to signal a decent reversal. Not awesome by any means, but it was okay. And it did what it was supposed to do. It went back to 786, and that's all that it owed us. And I was okay with that. So learn this reversal. It's one of about a dozen that are out there, and it's worth learning. But there's some nuances to it. Look at the red bar and how it closed. Even the open was below the halfway point. So we got this sort of a hammer candle bar. That by itself isn't the special part, it's just a piece of it. How that red bar closed. And then the next one, the wick below the last red candle's low, not a good pin bar, but a bit of a wick. And then the full run up, the full bar extension, and the close outside of the red bar. Pull the trigger. What does it owe us? Back to the 786. And if you can do that math and realize that wherever your stop goes, say the mid of that red bar is a good stop, or the mid of that green bar, if that distance is less than this distance by 50%, you're good because there's your 2-to-1. It wasn't the most beautiful setup in the world, but it was enough to tell me that we had finally stopped waterfalling and that I could try along to 786. And that's what it gave me. So, temper the expectations. This was not a reversal signal that said we could go to half or even back to the high of the day. It was just a reversal that said we could finally get a 786 pullback. Because I wanted to snap my fibs all morning and I couldn't even snap my fibs until we finally got that bar. I mean, technically, we could have snapped the fibs there, right? But it waterfalled through. So once we had that, which I did have that at the time, there was no other place to put fibs until we got there. So it was just a run back to the 786, which was fine because it's what it gave us anyways. So enough to take a trade, right? But RSI, stochastics, MACDs, nope, none of that trash would work. It's too fast because you're only one bar off from the reversal. A little bit. There is a little bit, and it comes with a what do you call them? A desktop. Oh, damn it! What's it called? When the image that you put on your desktop, wallpapers. Duh, that I couldn't spit the word out. It comes with a wallpaper, and it has like all of the patterns in it, and there's a book on the website too that goes with it. Um, those are a good starting point, but not enough. Not enough by a nautical mile. Not enough. The thing is, there's so much price action out there. What I would argue is the collective candle patterns, the ones that are like head and shoulders, uh, rising wedges, falling wedges, the ones that take 10, 12, 15, 20 candles to make, leave those alone for now. One, they're really, really easy to spot. Uh, Two, they're way too big for the intraday to really play out well. And you want to just focus on a 1 bar, 2 bar, and possibly a 3 bar play. And there's not a lot of those. There really isn't. It's a short list. Then the main thing, and it's the key to the entire thing, is to go into the past and look at reversals where price turned around. Study where price turned around and look at the good ones, because they're the ones you want to be able to identify as easily as possible. And then look at the trash ones where you're just like, oh, hell yeah, that's nasty. I don't want anything to do with that. Because when a good one forms, you just jump on it with both feet. And if it forms and it's ugly as hell, then you look at it and say, I'm not trading that. No, hell no. And you let it go. You just leave it alone because it's ugly as hell and you don't want it. And that's the best work that you can do, is to go into the past and find as many examples as you can of the good ones that you really want and the bad ones that you really do not want, and study them as much as possible. Just run your chart in the past, zoom in close enough, and start doing that. Guys, it is 75 degrees and it's Friday. I'm going to get my bike out for the first time this year. So this is on YouTube. I will post the restream into the chat. Let's dig into this next Wednesday with some of my favorite reversal candles, because there are some better ones, and we'll work on that. So everybody have a good weekend. I'll see you Monday.